The economy contracts as inflation accelerates. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, futures sink as the U.S. economy shrank more than expected in the first quarter in its first contraction since 2022.
That weaker eco data adding to market jitters as President Trump touts tariffs and slams the Fed chair again.
And earnings aren't exactly helping, with the parade picking up with company after company scrapping guidance. Microsoft and Meta take the spotlight after the bell tonight. And on that note, let's take a look at some of our earnings mover right now. We start with Starbucks. Sales continuing to fall as economic uncertainty adds pressure to the company's turnaround plan. Shares currently down almost 10% in the pre-market.
Wow. Caterpillar also moving and expects to face slightly lower sales this year if tariffs stay in place and the economy dips into a recession in the second half. The shares, though, up 2% in the pre-market.
Encouraging note for a bellwether in what's otherwise a kind of tough day now. We're looking at Snap as well, down 15.4% pre-market. They say macroeconomic headwinds are affecting its advertising business. Shares down heavily ahead of Meta earnings tonight. Of course, ads matter there too, Katie.
Back to the economic front, the Fed's job getting a bit more complicated by rising inflation and a shrinking U.S. economy, with GDP contracting last quarter for the first time in 3 years. Last night, President Donald Trump renewed criticism of Fed Chair Jerome Powell.
And inflation is basically down, and interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing. But I know much more than he does about interest rates, believe me.
Bloomberg's Michael McKee joins us for a day of busy economic data, and we still have more inflation to come, Mike. But to me, it looks like the economy is contracting and inflation is accelerating.
Well, that's what you're seeing in the reaction on Wall Street. We will get numbers at 10 o'clock on the March spending numbers and the March inflation numbers, and those will be more important to the Fed because they're the most recent and since the tariffs were put on. But we do have some bad news in the overall numbers, certainly, with GDP contracting. I think it makes the Fed's job a little easier because this report is so distorted by tariffs that there's no point in doing anything. GDP contracting by 0.3. But because of the distortions, what you want to look at is real final sales to see where the country really is, consumers really are, and businesses really are, and they were up 2.3%. Not a lot of help from the consumer side, up only 1.8% after a 4% gain in the fourth quarter. Consumers definitely pulling back. But look at business investment, up 9.8%. And if you go drill into that, 22.5% was equipment purchases, and probably most of that came from imports as people tried to run ahead of the tariffs being put on. Inventories, we were wondering about that because of all these imports. They hadn't shown up. They have shown up now, $140 billion. In the fourth quarter, they were $8.9 billion. So inventories alone added 2.25 percentage points to the overall GDP, whereas the number that we got from exports subtracted 1.25. So even with all that, we get a contraction. Federal government spending, I want to point out, did fall during the month. So it wasn't the government's contribution. And along those lines, we got the employment cost index. Wages and salaries for civilian workers up 0.8, but wages and salaries for government workers down by 0.2. That, I'm sure, reflects the Doge cuts that are out there.
Yeah, I want to pull up eCan Go on the terminal. This is Matt's favorite function, I think. He showed me it this morning. My eyes popped out of my head. That orange bar there is that net exports bar. It's what you were talking about there. It's with the imports really taking a hit out of the number. But how much of that, Mike, is people importing to get ahead of potential tariff price pressure issues in the future? How messy is that line?
Well, the line's a little bit messy because it also includes gold. And a lot of investors brought gold into the country in the first quarter because they were afraid that the president would tariff it. But it's not used for anything, and it's not consumed, so it doesn't count in GDP. So that had to be subtracted out first from those net exports to give you the headline GDP number, but it's still in that increase in export, the decrease in exports that you're talking about. And then in terms of the overall decrease in net exports, it's a lot of imports. It's that equipment, business equipment coming in, it's toys and games coming in. It's a lot of stuff that people tried to get ahead of the tariffs. Now, this is stuff that has made it to port. The big question is what's out there for the second quarter. There's a feeling among some economists that we're going to see a rebound because people will bring stuff in. But in this case, all we're hearing about is shipping being canceled.
Yeah, imports surging by an annualized 41%. That is the biggest advance in nearly 5 years. Mike McKee, we'll see you, I think, at the top of the 10 a.m. hour. That is Bloomberg's Michael McKee. Back to President Trump's 100-day speech last night and what to expect in the next 100 days. We're joined now by Bloomberg's Tyler Kendall, joining us from Michigan, where Trump spoke. Let's talk about the next 100 days, given that the first 100 are in the rear view right now. I imagine that he struck sort of a victory lap sort of tone last night, Tyler.
Yeah, hey, Katie. He definitely was talking to a very receptive crowd in Macomb County, Michigan, considered to be an auto hub. He really touted his tariffs, where he got a pretty welcome reception, including the biggest applause that I heard when he spoke about that 145% levy that's currently in place against Chinese goods, even if he himself has said that that essentially does amount to a trade embargo. He really tried to make this speech about boosting domestic manufacturing. He did touch quickly on those executive orders he signed yesterday, designed to give automakers some sort of reprieve when it comes to lessening the impact from his tariffs on them. Saying, though, that that really is only short-lived. He did it to give the private sector a little bit more time before he, quote, slaughters them if they do not reshore production. We do know that the private sector, of course, has been sounding the alarm about these supply chains are highly complicated, will take time to move, and they've been increasingly wary about making any changes amid so much tariff uncertainty. I can tell you that I was on a press call yesterday with some senior Commerce Department officials who said that they did make these moves to lessen the impact from the tariffs for automakers after their discussions with the private sector, that they wanted to show some flexibility in order to get them to move their production into the U.S. So that's something that we're going to be watching closely, particularly as Bloomberg News reports that today President Trump is going to be meeting at the White House with some big private sector CEOs as he tries to tout future investment in the United States. And I will just end on this. Of course, you were talking earlier about his ongoing criticism of Jerome Powell. He did mention there that he realizes that he should not criticize the Fed chair, saying, alluding to the central bank's independence, but ultimately saying that he thinks he understands interest rates better. I can tell you that in the room, it really did feel like he was passing on the blame here as he contends with the economic fallout from consumers and retailers alike.
Yeah, it does seem like he hasn't fired Powell because it's helpful for him to have the Fed chair there as a scapegoat for weakness in the economy due to his tariffs. Is that what others are saying as well?
Well, that's what it felt like in the room, because he really did try to tie that criticism of Powell to defending his economic policies amid what we have seen a flurry of polling coming out saying that American consumers are growing increasingly concerned when it comes to the president's economic agenda, particularly on tariffs. Now, Matt, he did dismiss that polling as being biased and was speaking in front of a crowd that was generally receptive to his tariff policies. We're going to have to wait and see. Of course, President Trump has previously said that he has no plans to dismiss Powell ahead of his term being up in May of 2026, even as his NEC director, Kevin had suggested that they were studying the issue. But for now, it really does seem that the administration is trying to thread the needle here between saying, you know, hold on, this is all about long-term growth, particularly when it comes to the tariffs, but at the same time trying to pass that blame, while also, of course, on the other end, I'll quickly note, trying to push forward that tax agenda. That's how President Trump ended his comments last night, saying tariff revenue will be included to include more tax cuts, be used as an offset, as Republicans in Washington today are getting started on working on that reconciliation package.
Tyler, we appreciate all of your reporting. That is Bloomberg's Tyler Kendall. Now, it is the biggest week of the earnings season and what has become a historic April for markets. Let's get a check on results as a whole with Bloomberg's Alex Semenova. Today is a big day. We've met on Microsoft and Apple and Amazon, as Katie calls it, the M's and then the A's.
Yes, makes it easy.
Way to remember it. How are investors setting up for these moments?
Yeah, so it's been obviously a very high-stakes earnings season. Looking back, actually, it's been pretty solid. About 43% of S&P 500 500 companies have reported results. And actually, year-over-year growth stands at about 10% right now. That's above preseason estimates. If you strip out the Magnificent Seven companies, it's about 5.9%, also more than analysts expected. But really looking ahead is where the problems begin. Consumer sectors have been starting to show cracks. If you look at some of the travel companies that have reported all withdrawing their guidance, sales misses have also surged. And guidance is actually the worst that it's been going back to the pandemic. And of course, we're heading into the busiest 2 days of the earnings season. 50 companies set to report today, 62 tomorrow. That's about $15.5 trillion worth of market cap. And obviously, some of the big tech companies will be most important. We have Meta, Microsoft today, Apple, and Amazon tomorrow. Those are going to be ones to watch.
Yeah, absolutely. Can really shift the tone of this market. But so far, the overarching theme seems to be the fact that you have all these companies pulling guidance. Now, taking a look at the sell side, which you follow very closely, the narrative heading into this moment was that we haven't seen estimates come down enough. Now that you have the companies themselves saying, we can't forecast the year ahead, what are we hearing from some of those analysts that we follow?
Yeah, so it's been really interesting, Katie. Actually, sell-side strategists have reduced their S&P 500 targets 7.5% this month. That is actually the most since the pandemic. So they were waiting for company guidance to come in, and they're really not liking what companies are saying. All this uncertainty, talk of volatility, and companies not really being able to quantify the impact of tariffs. And obviously, there is this concern that the economic data is going to get worse. Today is just a glimpse of what's to come. So even though we've had some stability after a really historically volatile April, there is this expectation that the hard data is going to disappoint, and that's going to trigger kind of further selling is what people are saying.
All right, Alex, thanks very much. We're going to continue to watch, obviously, earnings on this, the second busiest day of the quarter. Tomorrow, the busiest. Meta and Microsoft set to report after the bell. We're going to preview those results with Gil Luria, D.A. Davidson, head of technology research. And take a look at futures as we head to break. You will see that they are not positive right now. We have a drop of 1.5% on S&P futures, 2% on the NASDAQ. This is Bloomberg.
Now, Meta and Microsoft report after the market close, and the bar is set high for those Magnificent Seven stocks. If you take a look at how they've done this year, in fact, you can see that Meta and Microsoft are holding up the best among all of the Magnificent Seven. And indeed, you do have all of them, though, in the red for the year. Joining us now to tell you what to expect, we have Gil Luria, D.A. Davidson, head of technology research. If you have Meta and Microsoft relatively holding up the pack here, how high is the bar, especially for Meta, when a lot of concerns around ad spending are hanging over their heads?
The concerns are warranted. We expect Meta to come in a little bit between where Google did and Snap did. So Google held up well, really still on track in terms of the advertising spend, but Snap last night disappointed again and talked about some top of the funnel, some branding advertising falling off. The de minimis exemption going away matters here a lot. Temu and Shein are very big advertising spenders on these platforms. So we'd expect Meta to be somewhere in the middle. Now, fortunately for them, the guidance range for this quarter was very broad, 8 to 15%. So as long as they're within that range, as long as they communicate some level of visibility to the rest of the year, investors should be okay with that. But there's definitely vulnerability to advertising spend in a weakening consumer environment.
That's the question, right? Whether when it comes to the ad business, was Snap an outlier, or does that actually signal something to extrapolate for Meta tonight after the bell? I want to talk about guidance here, because we were just talking about this with one of our reporters, that the theme of this earnings season has really been companies just pulling their guidance altogether, in some cases downgrading it. Talk to us about what the reaction would be like if we saw a Microsoft, if we saw a Meta follow that track and downgrade their guidance or just scrap it altogether, Gil.
So for these two companies, they're actually in a pretty good position. So first of all, Microsoft has very resilient business for this type of environment. They have very little consumer revenue. Their spend is mostly on enterprise technology spend that has been tightened up recently. So they're in good shape, and they only have to guide one quarter ahead because it's the end of their fiscal year. they'll be able to do that without providing too much color into next fiscal year. Meta only guides 1 quarter at a time. So again, as long as they're guiding for more than 8% growth next quarter, they'll be able to get away with it. The tougher one will be Apple tomorrow. Apple's business is very much affected by tariffs, by consumer spending, by other measures between the US and China. That's where the guidance is going to become trickier.
It's interesting that you say it has something to do with tariffs. I want to bring up a Truth Social the president just put out on his social network. He says, "This is Biden's stock market, not Trump's. I didn't take over until January 20th. Tariffs will start kicking in soon, and companies are starting to move to the USA into record numbers. Our country will boom, but we have to get rid of the Biden overhang. This will take a while. Has nothing to do with tariffs." And he put that in all caps because he wants to really add emphasis that the bad stuff that's happening right now, has nothing to do with tariffs. Gil, is that true in your assessment as well? I mean, the advertising spend, the suspension of guidance, the pull forward in imports, does all of that have nothing to do with Trump's tariff policy?
Let me say it this way. Our consumer spending was slowing down before we started talking about tariffs. Consumer spending was already slowing down based on retailer reports of the fourth quarter of last year. Then we added DOGE, which is eliminating not only federal jobs, but federal spending. And then now on top of that, we're reducing immigration, which reduces incremental consumption. And then on top of that, we started introducing tariffs, which caused shifts in behavior in the first quarter and may cause some air pockets in this second quarter and into the third quarter. So all these things are cumulative. All these things are weighing the consumer down. And that's why you're seeing record low consumer sentiment. And soon enough, we're going to probably see declines in retail spending.
Gil, we thank you so much for your time this morning. That is Gil Luria of D.A. Davidson. He's a head of technology research there. Meta, Microsoft, after the bell, futures much lower this morning after economic data. Katie, is the president or is he not watching the stock market? I think I've lost a little bit of track
I think it's pretty clear that it's on his mind. It's interesting because the narrative was that, maybe he's shifting the blame to Powell. We know he had been heavy on Biden, that this was Biden's economy, this was Biden's stock market, and then he started to blame Powell. But we're right back to Biden. I do want to point out, if you look at the S&P 500's monthly performance, April is set to be the third straight month of declines. We haven't seen that since late 2023. So he makes the point in
now
the
this,
truth.
I will point out, this chart is not what you're saying.
No, this is not.
What this chart shows, and it needs the stock market to go the other way to be correct. If we actually climb just above 5,600 today, and I mean, futures are down right now 1.4%, so it seems unlikely, but you've seen shifts bigger than that. If we climb to more than 5,600, it will be the greatest comeback in a month that we've ever seen.
And I'm never going to say this as good as Michael McKee does, but that 10 o'clock data, it does matter because it will show you some of the cleanest inflation reads we've had since Liberation Day, I believe. So we'll keep an eye on that. It's still early yet, guys. Now, coming up, we're going to start the trading day with Truist Keith Lerner. He will be joining us next on These Crazy Markets. This is Bloomberg Open Interest.
At this stage, cash is king. So 95% of my money in the funds are in cash. I think right now we've got to keep cash and be ready to move when the time is right.
And that was emerging markets veteran Mark Mobius speaking on Bloomberg television earlier. Let's keep this conversation going now with Truist co-CIO and chief market strategist Keith Lerner. So 95% in cash. That's a little bit extreme, Keith, but talk to us about where you see your cash holdings, where they should be right now, because it feels like broadly there's a lot of exhaustion in this market, and there's still a lot of skepticism over the bounce back that we've seen.
Yeah, well, great to be with you. We downgraded equities, upgraded cash back in February when we thought the market wasn't pricing in much, bad news. And then we, again, on this rebound more recently, we downgraded stocks another level and upgraded cash. But to be frank, our cash levels are around 5%, not 95%. Even though we think the near-term risk reward is less favorable, we still have optimism longer term. And, from an investment portfolio perspective, there's risk of a lower market, but there's also a risk of not meeting your goal when you go to 95% cash.
I mean, Katie pointed out in today's meeting that Mark Mobius is only talking about emerging markets, and investing in emerging markets is very different than what Keith does, for example.
Yeah, it's a totally different animal.
I just thought it was a great soundbite and also an extreme number, so that's why we shared it there. What do you think of the comeback that we've made, Keith? I mean, it doesn't look like we're going to finish April higher, but if we do, it would be a comeback from an 11% drop since the beginning of the month.
Yeah, well, we had a shock period in the market, and at the lows, we were pricing in about a 60 to 80% chance of recession. We were telling our clients then, as long as you don't need to, don't sell here because the risk reward has become more favorable. But really, what's interesting today is the high in the stock market yesterday, 55.71 for the S&P, was the low the day before Liberation Day. So we've kind of basically went all the way back. But I will say, I think the outlook is more uncertain relative to then. And that's why we think the risk reward is somewhat less favorable at this short-term level.
Gil, sorry, Keith, we got to leave it there. Stick with us. We're going to check here on futures for a moment here because, of course, we've had a really rough morning in the market, Katie.
Yeah, absolutely. Just adding more losses onto April. Like we had been talking about, there was an enormous comeback this month, but you can see that momentum is fading on this last trading day of April. We'll walk you through all the opening action coming up next. This is Open Interest.
We are moments away from the start of trading, and futures are down more than 1% across the board. Of course, this follows an incredible winning streak. 6 days in a row of gains for the S&P 500. We haven't seen a streak like that in more than 3 years. But today, at least at the open, it ends with S&P futures down 1.2%, NASDAQ futures off 1.33%. Nonetheless, celebrating at the New York Stock Exchange, the board of QXO, because even though their stock is down 19% year to date, they have completed the $11 billion takeover of Beacon Roofing Supply, and they're totally pumped. As you can see, down at the NASDAQ market site, we have Yuan Bao, which is, I think, like a Chinese insurance company or something, and they're planning to list ADRs here in the States. Katie, what are you seeing in terms of the individual stock movers, some of them getting decimated?
Yeah, let's talk about Starbucks getting decimated, like you say. That's after they reported that sales continue to fall. We have economic uncertainty adding pressure to the company's turnaround plan. Remember, they got a new CEO in September, and boy, what a difficult time to try to execute that, Chinali.
Yeah, there are definitely some tough stories out there, but Caterpillar's actually on the rise. And of course, this is a bellwether stock. They expect to face slightly lower sales this year if tariffs stay in place and the economy dips into a recession in the second half. Caterpillar up 2.2% at the market open, Matt.
All right, so we're watching that closely, obviously, as a bellwether for the economy. Snap says macroeconomic headwinds are affecting its advertising business. This is the social network that I guess the kids still use. The shares are down 15%. This ahead of earnings for Facebook tonight. And we're obviously watching that very closely because they're very reliant on advertising as well.
Absolutely. Is Snap really the bellwether for Meta?
No, it's a great indicator ahead of Facebook. Don't we always look at Snap ahead of Facebook, right? Because they come in this order.
They had a pretty good beat when it comes to their ad business. So we'll have to see which Meta follows tonight after the bell.
We are back with Truist co-CEO and chief market strategist Keith Lerner. Keith, we're looking at a lot of pulled forecasts year to date, a lot of uncertainty out there. And my question for many weeks or months has been, does this get solved at some point? I mean, like after the 90-day period or after maybe the second 100 days or after the first year? Does the Trump administration at some point bring the certainty that markets and business leaders want?
Yeah, we can all wish. The reality is, though, we always deal with uncertainty, right? And from a stock
Not
market
at these
perspective,
levels.
yeah, well, it's about what you're being compensated. Are you being adequately compensated for the perceived uncertainty that we have today? And to your point on the business side, I mean, I talk to a lot of business owners. Really, what they want is, as you mentioned, some clarity. And even whether they like tariffs, don't like tariffs, they'll adjust once they know the rules of engagement. So, listen, I think the hope is, and really what you've heard from the administration is that we'll get towards some clarity. I do think the tariffs are going to be, used even well after this, in negotiations if something doesn't go right. So it's part of what we're going to have to, live with. Now, the question will become, do we become more numb to the day-to-day? And businesses will become, they'll continue to adapt. They adapted towards, after COVID. They adapted after the global financial crisis. Our companies will adapt, but it is causing a lot of companies in the short term to be somewhat frozen.
So what does this mean for the big tech companies? We're looking for Microsoft, Meta, Amazon, Apple, the impact they have on the markets. What inclination do investors have to allow them to keep spending billions and billions of dollars on CapEx? At the beginning of the year, this was a rewarded story. Is it still?
Yeah, it's a great question. And as I'm thinking our overall thesis, we're again, somewhat more cautious short term. The one thing, as we always press against our assumptions, is the tech side, because the technology sector and the S&P 500 isn't the economy, right? I mean, as we all know, we're driving a lot of this market by big cap tech. One thing we haven't seen during this earnings season, there still seems to be healthy demand for the AI side, right? And I think what's happening is that companies, even if we have a slowdown, there still has to be AI spending. Otherwise, companies will be left behind. So can we see a kind of a moderation in the tech spending, a little bit of less CapEx? Sure. But in general, what we're seeing, what we expect is they're going to still be somewhat a healthy spend in AI. And one last tidbit, towards the lows, the Mag 7 forward PE went to about 22. That's the same level it was around when ChatGPT was launched in November of 2022. The bigger question right now is that E, which was a little bit different than back then.
Yeah, when it comes to CapEx, really looking forward to hearing from Microsoft. Of course, we've seen reporting over the past couple months about them pulling back on data center leases. Maybe we'll get some clarity tonight, Keith. But I want to go back to your overall stance, because listening to you speak, reading through your notes, it seems like you're postured pretty defensively here. And I want to talk about what that means in this market, because defense used to mean just piling into mega cap tech, which up until a few months ago looked kind of macro proof. But now it feels like the story has changed.
Sure, yeah, I'll walk you through that. And the way we think as we're going through these periods of uncertainty where you're not maybe at this point being as adequately compensated for that risk, we're like an accordion. We bring some of our bets in, go a little bit smaller. We have raised, as I mentioned, some cash, we're closer to 5% per se. And then in the allocation side, we brought down equities a little bit. We still have a tilt towards large cap equities. Earlier this year, we actually downgraded small caps. We have a little bit more international than we had before, just because the back and forth. We've been big bulls of gold as well this year. I will say on a short-term basis, it just that rubber band got too stretched. So I would wait for a better opportunity to add here. And then from a sector perspective, because we expect this back and forth to continue, we do like utilities, which is more defensive. We have our favorite cyclical, which is financials, and our favorite growth area being communication services, because we expect this kind of choppy back and forth to continue.
What do you think about the Fed? I don't want to go the rest of the show without talking about the economic data we got at the top of the hour, or that which is coming at 10 o'clock. It looks like growth is contracting and inflation is accelerating. Is the Fed still going to be able to cut?
We think they will. I mean, our base case is 2 rate cuts this year, but we also acknowledge the range of outcomes is pretty wide. When we look at this market move and bringing back the Fed into the conversation, this move off the lows, the 6 days up, the strong breadth that we've seen, typically when you look at these type of things a year later, the market has been up, and the percentage of times it's been up is really highly skewed to the positive side.
Keith, are you referring to the Swag breadth thrust indicator?
Swag breadth, that's one of them. Yes, I'm very familiar with that as well. Part of my background is on the technical side. So that is all positive. And normally if I'm just a straight technician, but I'm looking at that saying that's a real positive, and it is. But the one thing right now, when we look back at some of these other signals, you had a policy response. Or coming out of COVID, you had the fiscal and monetary bazookas come out, and then going back after the financial crisis, it was more delayed, but you had that coming in. Right now, policy is more constrained, and that's also why maybe as we look at this weight of the evidence approach, looking at the fundamentals, the technicals, the economic trends, we're less bullish than we would by just looking at those one signals, because again, we think the Fed is somewhat constrained and a bit in a pickle here because the economy suggests they should be slowing down. I mean, should be maybe being more aggressive, but they're constrained by that dual mandate on the inflation front.
Keith Lerner, co-CIO and chief market strategist at Truist. We thank you so very much. Matt Miller, can you describe to me exactly
So the SWAG breadth thrust indicator, which actually Katie turned me onto through her social media addiction.
I did.
Is apparently when you have positive breadth at only 40% of NYSE traded stocks, and within 10 days it goes to more than 61.5%. According to many people on Twitter, which is a reliable news source.
Social media is real life.
19 out of the last 19 times that's happened, we've been up like double digits, 6 months out and 12 months out even more, like an average of 15% and 25%.
We spent a lot of time on Friday talking about it. Rob Arnott called it silly, so that's my Bible now. I will say that the yield curve was also a great indicator until it wasn't anymore.
And the Claudia, the Sommer rule.
Exactly.
So we're seeing indicators broken, but it just, Keith is a technician as well as a CFA, and he had pointed out,
In any case, I now feel out of touch. We're going to get a look at some of the more stocks moving under the hood this hour. A lot of earnings. We're going to bring in Bloomberg's Nora Melinda for that.
Shanali, lots to keep an eye on this morning. I'm looking at Weight Watchers. We're seeing shares of the company surging for a second session. Now, this is after it's partnering with Eli Lilly to streamline access to Zepbound. We're seeing a lot of these consumer marketed brands really trying to delve into the space of weight loss drugs and management for their consumers. I mean, we just saw Hims & Hers striking a deal with Novo Nordisk most recently, but we're seeing shares of Weight Watchers up for double-digit gains this morning, but also in the consumer space. I'm keeping an eye on Starbucks. We're seeing shares of the company declining, falling about 10% right now. This is after the sales of the company missed expectations. And we know that we had the new CEO, Brian Nichols, who came back. He came to the company back in September. He's really been trying to revamp the firm, but he did acknowledge that their earnings did fall short. But he really is assuring people that they are seeing a lot of success and progress behind the scenes. But that doesn't seem to be enough to convince investors at this current moment. Lastly, I'm keeping an eye on Supermicro. They reported preliminary earnings that fell short of expectations. And of course, this is super important, being that we're kicking off tech earnings today. We're going to hear from Meta, Microsoft, and Qualcomm later after the closing bell. But the company, Supermicro Computers, is citing higher inventory and customers that were really delaying purchases. That is the culprit for this sales, or for the preliminary results missing expectations.
Unsurprisingly, that is your biggest loser in the S&P 500 right now. Nora Melinda, great roundup. Now, coming up, Booking Holdings tweaks its revenue outlook due to increased uncertainty. We'll speak to the company's CEO, Glenn Fogel, next. This is Open Interest. Welcome back to Open Interest. A sea of red behind me. Of course, we got that ugly economic data at 8:30, hotter inflation, negative growth. You can see that expressed across indexes right now. We'll continue to follow that story, but it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Wells Fargo out with a flurry of rating changes in the retail space, citing tariff headwinds and expectations for a mild recession. The firm upgraded Levi Strauss, Canada Goose, and VF, while downgrading Gap, Nike, Carter's, and Victoria's Secret. Next up, we have Goldman Sachs cutting Starbucks to neutral after earnings. Goldman expects a slower path to a North American sales recovery for the coffee chain. And finally, Airbnb getting upgraded to a buy over at D.A. Davidson. The analyst sees durable growth trends for this home rental company, Matt.
All right, so we're going to continue to talk about the travel sector. Booking Holdings can be added to the list of companies citing an uncertain future ahead. The company beat estimates on EPS and room nights sold, but tweaked its revenue outlook due to increased economic uncertainty. For more, we're joined by Glenn Fogel, the CEO of Booking Holdings. And Glenn, first off, you're an international business, right? You're a global business. So I wonder if you see international helping a little bit to offset weakness in the U.S. I was looking deeper into Katie's Starbucks numbers today, and I saw that the U.S. is the problem for them. They have a drop of 2% for same-store sales here, but internationally a gain of 2% for same-store sales. Do you see something similar with your bookings?
Well, look, we were very pleased with the numbers we came out with last night about the quarter. And we did talk, we gave a global sense that travel's steady, and we're pleased. But we were also willing to say that the U.S. probably lower than other parts of the world. And we gave a regional breakdown in talking how the U.S. was growing slower. But I want to make the point growing slower than other parts of the world. But we're a very global company. You know what's interesting is the way you opened up, though, talking about us tweaking our longer term, our full year guidance. And it's interesting the way people read that. And I wonder, we should have said something a little differently, because we'd come out originally, beginning of the year, with our full year guidance, about mid-teen, we said EPS, adjusted EPS. Now, last night, we come out and we say, hey, we're still feeling good about this. We're still looking fine, but we recognize the world may be more uncertain, but we made the point, we haven't seen it yet, really, but we're willing to say we should widen the lower end of this range, which is what we did. And I wonder, did people misinterpret that and start thinking that we're concerned? Look, we all see what's going on in the news, and we see there's potential changes. We haven't seen that yet, and we're very pleased with the results we put out last night.
You're hearing really mixed outlooks from CEOs in the travel industry. You just take the cruise lines alone, and you have Norwegian warning about softening demand. You had Royal Caribbean saying pretty much the opposite. They hiked their outlook. When you look at the U.S. in particular, there has been this worry about softening demand. What kind of color can you give around where that's exactly coming from and where people are going instead?
Yeah, we talked a little bit about that last night, and certainly at the lower end of the economic strata, the lower star-rated hotels, you see a little bit worse positioning there than the higher end of the economic ladder, where people are still more than happy to go out at that 4- and 5-star hotel. And we're seeing in terms of the length of stay, perhaps, at the lower end in the U.S. But again, U.S., just one part of our business. We're extremely global. You know, we did 319 million room nights last quarter, and they were done throughout the world. So, yeah, one part of the world could be soft, but as long as other parts of the world are doing well, as a company, we do fine.
Well, let's talk about how you manage around this uncertain macro environment, softening demand in the U.S. What can you do to boost revenue specifically in this region? What levers do you have to pull?
Yeah, you know, one of the great things having been at this company, I've now been in our company 25 years. I became CEO in 2017, January 1. So I've been around the block a few times, and there have been good times, there have been bad times. There have been recessions, and there have been great boom times. The fact is, when things get softer for the travel industry, we provide it's a great opportunity for us to provide stuff to our partners, those are the hotels or the airlines, providing ways for them to get whatever demand there is. I can't increase the amount of total demand. I can't get people to travel more. That's the Fed, that's Congress, that's the government to try and increase more general demand. What I can do, though, is come up with tools and ways for our suppliers to work with them to enable them to get a higher, and we've seen that. Whether it's a good time or bad time, we've been increasing share. And I'll tell you, sometimes the soft times are the best times for us as a company to increase our share because of the incredible amount of data that we can use to pinpoint where the demand is and how can our supplier partners best access it.
You remind me of the serenity prayer, right? You need to recognize the things that you can change and the things that you can't. It looks like you've been doing a fantastic job. I look over the last 5 years, and your stock has returned more than 260%, so absolutely crushing the S&P, which is up only 128%. What are the levers that you want to pull throughout the rest of the year to kind of offset the uncertain business environment? Are you going to be cutting costs, for example?
Yeah, so look, I like that chart you showed. I like it better to go back when I first joined this company in 2000. Our low there, $6 a share, okay? 4,800 now. That's 800 times. That's over a quarter of a century, over a 30% CAGR. That's good, consistent, execution by our team. And one of the things we do is make sure we are being cost conscious and spending where we should. We actually, before all these things started happening last year, we talked about a program we're going to save $400 to $450 million a year once we got the program fully done through. And we talk even this year alone, it takes time to get this into place, we're going to save $150 million. It's going to be on the books this year, albeit it's not going to come until the second half of the year, most of it. We haven't seen it in the first quarter. But these are the things that we do, making sure we spend the money correctly so we can provide a better service to our supplier partners and our traveler customers. And that's why we've been able to achieve over a 30% CAGR for a quarter of a century. That's a good result.
Glenn, as a CEO, how do you feel in this market? Do you feel like it's a moment to batten down the hatches, or do you look around? You have so many brands, Kayak, OpenTable, RentalCars.com among them. With valuations under pressure, do you think maybe, okay, it's time to acquire another brand?
Well, I won't talk about M&A, but I will tell you that bad times can provide great opportunities. And I mentioned that already about getting shared such and making investments. A lot of times, I believe, people feel a need to pull back because of short-term circumstances. I think that can be a really bad thing to do for the long term. So as I said, we're always cost conscious. We're always making sure that we're not spending money wastefully, but we also want to invest for the future. Look, we're putting a lot of money into generative AI right now. We're coming up with some great new tools, great new ways for people to be able to get travel easier, more seamlessly, frictionlessly, or being able to provide services to our partners. I mean, just today, right now, you can go to kayak.ai. That's a new Gen AI thing that we put out. So yes, we want to make sure we spend carefully, but just because it may be tougher times does not mean we should stop investing for the long-term future.
All right, Glenn, always great to speak with you. Appreciate your time on this earnings day. That is Glenn Fogel of Booking Holdings. I do want to point out the long-term performance of Booking because I had to check this chart a few times. Up 230% on a total return basis over the past 5 years. You compare that to the S&P 500, only up a pedestrian 102%. So clearly crushing the S&P 500.
How about this?
Yeah.
I'm sorry, I don't mean to cut you off. And I'm not correcting you, but I'm pointing out this goes back 25 years.
Yeah, that is an even longer term.
Up 919. Well, Glenn said, I wish we could show the chart to back when I started 25 years ago. And guess what?
Do that.
We can.
The power of the Bloomberg terminal. Meanwhile, we're going to continue the conversation on travel in the next hour with Sommer, the CEO of Norwegian Cruise Lines, will join us at 10:30 a.m. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing. About 25 minutes into the trade, they are down more than 2%. The S&P ending a 6-day winning streak with a real plummet, and the Nasdaq falling even further, 2.3%. It's interesting if you look at what's going on in the 10-year yield. We're coming down, and that's a real reversal because we had seen the yield shoot up after those GDP numbers came in, showing a contraction in the economy, showing acceleration in inflation. Microsoft off almost 2%, Meta down 4%. We're expecting earnings from these companies. And then, Porsche, thank you for putting that there, down another 2% today, and Stellantis down 4%. Stellantis, another one of those companies that's pulling its forecast for the full year. Uncertainty is definitely having its effect, although Donald Trump has put out a Truist Social saying this has nothing to do with tariffs. Coming up in the next hour, Rebecca Patterson shares her investment strategy. Then billionaire Marcelo Claure talks about his new role, and we'll talk to the CEO of Norwegian Cruise Lines. They're going the other way and saying demand is softening. Sommer joins us. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Shanali Basak.
And I'm Katie Greifeld. We're taking a look at the S&P 500 on the back foot today. We got some ugly economic data this morning. We'll get some more in just a few seconds. You can see the S&P 500 down by about 2.2%, with big tech leading the declines ahead of earnings as we await for personal income and personal spending data for March. And here it is. Personal incomes rising by 0.5% in March. That is slightly ahead of the expectation of 0.4%. You take a look at the personal spending figure coming in at 0.7%, also slightly ahead of expectations here. You go down the list, you get some more PCE figures as well. We got core PCE this morning, and now the PCE price index coming in flat month over month for March. Sonali.
Katie, let's break down the data with Bloomberg's Michael McKee. It's been a very busy morning, but the March data incorporates a little of what we've seen in tariffs, doesn't it?
Well, the data are pretty much all about the tariffs today, but the numbers that we get for March on the PCE are good news. These are the droids that the market should be looking for instead of paying attention to the quarterly numbers that we got at 8:30. PCE price index for March comes in flat, 0.0, which pushes the year-over-year number down to 2.3% from 2.5%. Fed's target is 2%, so we're getting ever closer. The core also flat, which is a kind of a surprise. The year-over-year number there is 2.6%, down from 2.8%, actually down from 3% because the prior numbers were revised up, and the PCE headline was revised up to 2.7%. And that shows you that there are some revisions that we got to January and February that put us in line for what we got today, because the number we got today for the March numbers is very different from what we saw in the quarterly figures. Quarterly PCE up 3.7%, and the quarterly core up 3.5%. And that set off a lot of hand-wringing on Wall Street that perhaps is not justified. Income and spending comes in at better numbers than anticipated, up 0.5%, although the number for the prior month for February was revised down to a 7/10 gain from an 8/10 gain. That's still a fairly strong income or spending number, rather, and income's up 0.5% during the month. We're seeing some strength there. So consumers hanging in there. And I want to point out that in the GDP numbers, if you were Donald Trump, you wouldn't be waving this off as not my fault. You'd be pointing to the real final sales to domestic customers up 2.3%. Because of the distortions I mentioned. If you break it down, consumer spending was 1.8% during the quarter, better than expected. Businesses up 9.8%. Now, 22.5% of that was equipment. All of that was pulling forward the tariff buying, people getting ahead of the tariffs. And that showed in imports, they subtracted 5% from GDP, while inventories added 2.25%. So basically what we've got is a tariff-distorted first quarter GDP number, and then the numbers underneath that are better than we anticipated. So if I were the president, I'd be talking up the report rather than talking down the report, even though most people are going to focus on that headline 0.3 contraction.
Well, I'm happy to tell you, Mike McKee, that you're thinking along the same track as Peter Navarro, who said this was the best negative print for GDP I've ever seen. So, you know, genius minds. Michael McKee, thanks so much for joining us there. Let's get to Rebecca Patterson, Counsel on Foreign Relations, Senior Fellow, and former Bridgewater Chief Investment Strategist. Glad to have you in the studio. Thanks so much for coming in. Interesting to see inflation get ever closer to the Fed's 2% target. And Sonali points out we're now firmly pricing in four cuts, yes, for the year. We all care how much the Fed can take rates down. But do you expect these numbers to start picking up as we get data later in the year?
The inflation numbers, yes, the inflation numbers are going to be biased higher as we go into the coming months. I think it's a question of how quickly we feel those effects. You know, we got comments from the head of the LA ports last night suggesting that within the next 2 weeks, they expect to see shipments coming in from Asia down 35% from a year ago. But that's just the ports. Then we have to get things to the trucks, and then we have to get them in the stores. But as supplies dwindle, and if the consumer still has a job, still has income to spend, they're going to be paying more for what they can get. So I don't think we see it tomorrow, but we're starting to see little inklings of it, and it's going to keep building over the coming months. So I do think the inflation data is biased higher, and given that, you know, it's going to be very difficult for the Fed to cut. I think the first cut is priced in for July. You would have to see the job situation deteriorate materially for that to be the number one concern for the Fed versus inflation.
Well, let's talk about that a little bit more. We're a week away from the May meeting for the Federal Reserve. As we mentioned, market pricing in 4 cuts right now for 2025.
Firmly.
You're saying that that's going to be difficult to deliver on. But, I mean, when do you think that the balance shifts from, okay, inflation is high, we have to stand pat, to, oh boy, look at this economic environment, take a look at these growth figures, we have to do something?
You know, the good news is we started this year in a strong place. You know, we had record household wealth, we had a strong job market, people have incomes, we had low consumer and business leverage. So that allows us to slow, but at least from a high level. We also have, and we're going to see it in the earnings numbers and the corporate guidance in the coming days, the big tech companies are continuing to make this race on AI. And so they're just going to continue to put in the CapEx dollars, which is a support for the economy, all else equal. So we are slowing. The question is how bad and how quickly. I think companies are going to be reluctant to lay off more workers than necessary because there's so much, I'm sorry I'm going to use the word, uncertainty.
And because of the experience they had after COVID, right?
Exactly, right. They don't want to fire too much and then have to turn around and rehire. It's disruptive and it's very expensive. So I think we're going to probably see a softer labor market. The question is how quickly and how much momentum does that get? I think it's going to be a slow grind.
I want to pull up also a note this morning, trying to look at the bigger picture here for a moment. There's so much day-to-day headline drift. Apollo actually warned investors in recent days about risks to U.S. markets. And they talked about that premium that U.S. assets have against the rest of the world. And they warned that this is at risk. They say the longer and more volatile the path to a trade policy reset is, the greater the risk to this regime and its benefits.
Yeah.
How worried are you about that longer-term shift in the middle of all of this noise?
I agree with Apollo on the likelihood, increasingly confident of a shift. So when I was at the IMF World Bank meetings in Washington, D.C. last week, I had the opportunity to speak with dozens of investors from overseas. And I think sometimes here in the States, we underappreciate how important this source of capital is for U.S. assets. You know, as of the latest Treasury data, $31 trillion in U.S. stocks and bonds. And when I talk to people who are running pension funds, sovereign wealth funds, et cetera, they're thinking they have to have a new risk premium on U.S. assets, that U.S. assets, you can't see them as attractive as they were before because of the policy uncertainty, because of the tariffs, because of the U.S.'s standing as a reliable partner. And so if they were to simply reallocate 2% off stocks, 2% off bonds, that would be a $1.24 trillion capital flow. So it's going to continue to weaken the dollar. Doesn't mean stocks can't go up, but it removes a pretty important source of support. But to your point, it's not a Liz Truss moment. This is going to be a slow bleed that happens over months because these firms have to go to investment committees, get things approved. It takes a while, but I think increasingly it's likely to happen. So it's, as we look at all the day-to-day, it's important to have that in the backdrop.
I think it's a great point because we've seen such swift moves in this market, right? After Liberation Day on April 2nd, the market's absolutely puked. For 3 days in a row, right? Yeah. Banks calling in traders on an emergency basis on Sunday night. And then after President Trump backed down, we soared. So real fast movements. But your point is that these big sovereign wealth funds, they're not quick like that. They're slow and plodding. So even if we see a crisis on the shelves of Walmart or Target, which we have yet to see, by the way, but if we do, you don't necessarily see the flows all disappear like that.
Right, right. And I will be excited when I see some proper data to prove this. I would guess a lot of the flows we've been seeing since the pause on tariffs has been U.S.-based retail investors, shorter-term investors. So that's the fast speedboat noise going up and down in the markets day to day. Meanwhile, we have these tankers in the background. And I'm talking about the foreign investors. There's also U.S. investors who might have gotten overweight the big tech stocks, overweight the U.S. markets in recent years because it was the right call. And they might be saying, maybe I need to trim that a little. I think there's that possibility, too, in addition to the $1.2 trillion I mentioned. The foreign money is important for the dollar. And the dollar is important because of inflation. Because if the weaker dollar continues and adds to import prices and that feeds into inflation, it's another reason the Fed's going to have to go more slowly than President Trump would like.
Rebecca, we have less than a minute here. The slow bleed, the potential for that capital exodus, a lot of this is in the hands of one man. It's in the hands of the president. If he were to reverse completely and the trade war were to end tomorrow,
First of all, I don't think we'll get a complete reversal. The 10% universal tariffs, I think, are likely to stay. They're going to use that as revenue to help pay for the budget. But also some measure of China tariff is going to stay. And don't forget, we have 6 different Section 232 investigations underway now. Some point, probably late summer, we're going to see the results of those. 6 different sectors that we could see new additional tariffs on. So I think hope springs eternal. But my best case scenario is that the tariff level we settle at is multiples higher of where we were in the 1930s.
Rebecca, we thank you so very much for your time, of course. The short-term and the long-term thinking from Rebecca Patterson from the Council of Foreign Relations. Now, coming up, Marcelo Claure is expanding his investment empire. We're going to talk to the billionaire about his new role at Brightstar Capital Partners. That's next in the Wall Street Beat. This is Bloomberg Open Interest.
China is not behind.
Anybody ahead of you?
China is right behind us. I mean, we're very, very close. But remember, this is a long-term. This is an infinite race. There's no, in the world of life, there's no 2-minute end of the quarter. There's no such thing. And so we're going to compete for a long time.
That was NVIDIA CEO Jensen Huang speaking with Bloomberg's Anne-Marie Hordern. Huang is one of the tech titans gathering with lawmakers for a summit on how cutting-edge technologies can bolster national security and American manufacturing. Which brings us next to the Wall Street Beat. Billionaire Marcelo Claure is joining Brightstar Capital Partners and expanding his significant minority stake in the firm. As partner and co-chair, he's going to focus on extending Brightstar's middle market reach, implementing AI initiatives across the firms that they own. Marcelo is the former CEO of Sprint and SoftBank. He was the COO there and the largest individual shareholder of T-Mobile, and he joins us on set now. Thank you so much for joining right on the heels of a new gig, nonetheless. So why middle market private equity? How come this is the next frontier for you?
So thanks for having me here. And I've been busy running my family office and doing some fascinating investments, but I've spent a lot of time understanding the power of AI and what can AI do to companies. I've seen it through my investment on K-Health, how today our AI doctors are significantly better than traditional doctors and pretty much operating some of the major health institutions. And I've also been part of something that few people report, and I call it the AI transformation at T-Mobile. And publicly, T-Mobile has said that in the next, from 2023 to 2027, profitability will increase by close to $10 billion. And that's mainly through the AI transformation and all the operational efficiencies that T-Mobile is doing. That as an active board member, I've been following that. I'm fascinated by what can AI do to businesses. My story with Brightstar goes a long way back. A lot of people don't give enough credit to middle market. I don't know if you know, but middle market is the engine of this country. It's the engine of America. And what's expected in the next 20 years, there will be about $105 trillion of transfer of wealth, what I call it the largest transfer of wealth that's going to go from family-owned businesses. And in many cases, their kids don't want their parents' business, or their parents don't want their kids to have it. So that's a great place to go, buy large businesses. There's some that are quite large. So I figured that everything that I've learned in my career by being an operator, an investor, and an entrepreneur back in my days at Brightstar, I could apply to work at this. So I've expanded my ownership into Brightstar. And I'm ready to, get back in the world of controlled investing.
It's a really interesting time to enter the middle market because in this particular moment, and you see it in different stock indices. You see it in, for example, the Russell 2000, where middle market companies have been left behind because people are worried about how they're going to fare in this economy, in the middle of the tariff wars. How do you see smaller businesses navigating, given that, as you said, they are the lifeblood of the American economy?
I mean, I wouldn't call them smaller businesses. Some of these businesses have profitability of $100, $200, $300 million. So it's not your traditional small businesses. And I think these are entrepreneur-driven businesses who've been in business for many years, who've gone through turbulent times. They've been through tough times in 2008, 2009. And I think these are probably the most resilient businesses because they're doing your traditional everyday businesses that are going to continue to be there for a very long while. So, you know, I'm fascinated by the size of this business, by how many they are, and by the amount of value that has been created. We're talking about, again, $105 trillion of wealth that is going to be transferred to, you know, to a next generation. And the next generation, in many cases, do not want their parents' business. So this is a great place to be a buyer's market. And then secondly, another area where we see tremendous opportunity, I mean, there's close to $4 trillion of value sitting today in traditional private equity, about 29,000 companies that are stuck there in many cases for 4, 5, 6 years. And nothing against traditional big private equity, but our mindset is we're operators by nature. That's what we've done. And a lot of these businesses are up for sale today that you can buy. You can put operational efficiencies. You can put a lot of AI into these businesses and make them great businesses that can be sold to potential strategic sponsors in the future.
So I hear what you're saying when it comes to traditional private equity. So you're drawing a line of distinction there, but tell us exactly how you're different. So you're saying that you're going to come in and be an operator and work with the business as opposed to maybe some elements of what you call traditional private equity.
And I think I've been very lucky, right? I started my first company, Brightstar, became the world's largest distribution company in the wireless business. I was given the chance to turn around a Sprint. We merged it with T-Mobile. Today, we're the world's most valuable telecommunications company, and we've always been able to apply operational expertise. That's my core, right? And I'm happy that we can buy businesses and apply the same playbook that we've used. And I think we can go head-to-head against any private equity company in terms of our operating expertise, and that makes us very, very different. And thirdly, AI, right? AI is the biggest transformational revolution that we're all going to live. And I'm so lucky to be the chairman of the AI Institute at Harvard. I'm one of the largest shareholders of the largest AI primary care physician doctor. I'm the active board member in the AI transformation at T-Mobile. So I want to be able to apply those learnings, buy companies, put traditional mechanism to reduce costs, but more importantly, insert AI into those companies. And, you know, there's a lot of people saying, hey, we can do that, but who's really doing it? These are venture and growth equity who've actually never done full buyouts, and I think we have a competitive advantage. So that's where I want to transform Brightstar to be.
You are talking about businesses, services businesses that rely, though, on hardware to get the job done, right? That's what AI is, essentially. Yesterday, Scott Bessent was talking about giving tax breaks to people building factories here, giving tax breaks to people buying equipment here. Do you think that the businesses that you're connected with are going to be able to shift to onshore their production, or the hardware companies that you're reliant on are going to be able to build their products here in the U.S.?
I mean, some of them. I mean, the great thing about this country is we are the largest market in the world as it relates to consumption. And if there are economic advantages to manufacture locally, there will be firms who will move to the U.S. who are going to move their manufacturing capabilities to the United States. Not easy. We have lost that edge. Traditionally, other countries have taken that advantage. But if the right economic incentives are into place, I'm sure that the U.S. can become a good manufacturing. Not of everything.
Is it an edge, though? Do you want, like, your kids working on the factory floor building smartphones here, or is it good to have that kind of work outsourced to another country?
I think it depends. I don't think we should judge by, hey, somebody's in the manufacturing jobs. There are great manufacturing jobs, especially in high technology and all that. And I think there is jobs for everybody. And there are some people who would want to choose that craft, and there's some others who want to be in the services business or who want to be in technology. So.
But what about this tension that is being built? And this is beyond the trade war. We saw it in the DeepSeek moment, for example, with investment in AI, making it cheaper, faster. It's not just China, it's the Middle East as well, to a large degree. I think that's an undercovered story in a lot of ways. What does the U.S. need to do to be competitive at a time where a lot of people are questioning their investment in this country?
So I would say the U.S. is a leader in innovation, right? Chipsets, AI, this is where innovation is born, right? Silicon Valley, from an AI perspective, is back, and that has been our strength. I mean, nothing will happen without the incredible, 5G network that have been built in this company that allow you to open your phone and ask the right questions or put the right prompts into ChatGPT. OpenAI is a U.S. company. NVIDIA is a U.S. company. I mean, some of the leaders in what's driving the biggest revolution of our lives are U.S.-based companies. So I don't think that's ever going to change. I think the U.S. is going to lead on innovation. Now, do we want to bring some manufacturing jobs to the U.S.? There will be some industries that can adapt to that, the car.
Right.
Then there's some that won't. And then the world has a way of reallocating resources to figure out where is going to be the most efficient place for innovation, for manufacturing, for technology deployment.
All right, Marcelo, unfortunately, we have to leave it there. Great to spend some time with you. Congratulations on the new venture. That is Marcelo Claure of Brightstar Capital Partners. This is Bloomberg. We do want to bring you some breaking news. This coming from FT reporting that the U.S.-Ukraine minerals deal hits a last-minute hurdle. Bloomberg News reported this morning that Ukraine is ready to sign a natural resources deal with the U.S. in a matter of hours. Now, according to the FT, that's hit a hurdle. We'll continue to follow this story next. This is Open Interest. All right, welcome back to Open Interest. Norwegian Cruise Line says that there could be some choppy water ahead. Specifically on its earnings call this morning, the company says it sees softening in its 12-month forward bookings. In a statement, the company CEO, Harry Sommer, said, quote, while we recognize there may be potential pressures on the top line, we believe that these can be effectively offset by the continued execution of our cost-saving initiatives. I'm pleased to say that we're joined now by Norwegian Cruise Line CEO Harry Sommer. Harry, it's great to have you with us again. So you stand apart from some of your peers because we heard from Royal Caribbean, we heard from Carnival with pretty upbeat outlooks. Talk us through what you specifically see in the year ahead.
So first off, good morning, and thank you for having me on today. Listen, we're still seeing very good booking activity for Q4 and 2026. I think the softness that we talked about just was on one specific product, Europe, in 2023 for Q3 of 2025. My apologies. But if you looked at our book position on a 12-month basis, we're well within our optimal range. We're above historical averages, and our 2026 book position is actually well ahead of historical averages. So yeah, one soft spot in Q3 for Europe, but the rest of the booking curve looks really, really good.
So you cater to a higher income consumer. Do you think that's the issue, or are people with higher incomes watching their wallets more closely, or are people who are new to cruises that really decided to try it out after the pandemic, is that demand waning, or what's going on exactly?
No, I don't think any of those things are happening. I think the higher income consumer is doing well. I think the middle income consumer is doing well. We don't really cater to the lower income consumer. I think it's specific to one area, Europe in Q3. I think Americans are looking to look a little bit closer to home, and we're happy because our deployment in Q4 and Q1 and even to next year favors those closer to home itineraries, which is why we're seeing a good book position for those future periods.
But even with the closer to home kind of strategy here, how many issues are being created? Because you have a few things going on. You have consumers potentially worried about inflation, maybe hesitant to spend more largely. You also have a dynamic where a lot of people are seeing that international consumers are really slowing down when it comes to the United States. How are you grappling with those trends that might continue for months?
You know, I think this is where the cruise industry's unique position really acts as a tailwind, if you will, a benefit, because we represent such a good value compared to hotels and other vacation alternatives. So, I mean, you think about everything that you get on a cruise, from food, entertainment, spas, casinos, the whole 9 yards, and a great consistent product. It really represents a great experience and value gap versus hotels, which is why we tend to do better as an industry. I mean, you look at our yields compared to what Hilton just announced yesterday, we're still well ahead of them. And I think that's going to continue into the future. People like to vacation, And if there are going to be modest recessionary challenges out there, I think value, which cruise lines provide in earnest, really should win out.
So there's a lot of uncertainty among consumers, which you know well right now. I want to talk about uncertainty that you might be feeling. I was listening to Bloomberg Surveillance this morning, and I forget who said it, but someone made the great point that you have to have stable policies to encourage companies across the supply chain to invest. And when you think about where you stand right now, looking at 2026, for example, how do you feel versus at the start of 2025? Are you thinking about things a little bit more conservatively than you were maybe at the start of the year?
Listen, clearly we're not immune to macroeconomic conditions. We saw the economic news that came out this morning. And so we're redoubling our effort, not just to maximize every dollar of revenue and emphasize the points that I mentioned before about cruising being such an incredible value, but we're also looking at cost control. We would be foolish not to see that there's a potential for weakness going forward, and we're doubling down. We set up a transformation office to sort of reimagine the way we deliver services and buy things, not at the expense of consumers. We're super passionate about delivering a great onboard product, but we think that we can buy things better, and we announced a $300 million cost savings program last year. We're going to accelerate those cost savings, but again, never at the expense of the guest experience. And we believe that if we can accelerate those cost savings initiatives, we'll be able to offset any potential challenges on the top line.
What are the, if I look at your stock performance versus, and Caribbean as well, versus Royal Caribbean, Carnival versus Royal Caribbean, I see real underperformance. What is the biggest competitor in the market, Royal Caribbean Cruise Lines, doing that investors love so much? Like, what can you look at them and learn?
I think there's really two critical components. They started their closer to home and private island strategy a little bit before us. So obviously they have first mover advantage, and they've had the benefit of having that for the last couple of years, where we're really just getting into our closer home private island strategy now. So they've built up this benefit over a year and a half, which we think we can now rapidly catch up on during 2026. I think also it's a challenge of leverage. On an enterprise value basis, our valuations haven't changed that much, but because we are higher levered than them, we don't have the same equity return. But we're super focused on reducing our leverage. We're going to get it down to 5 times by the end of the year, and in the mid-4s by the end of next year. And obviously that will help with our equity valuation as well.
I'm very glad you brought that up. If you pull up DDIS on a Bloomberg terminal, you can see your kind of entire capital stack here. And how quickly do you think you could pay down that debt, given the focus that the industry really has on doing so?
So, we already decreased our leverage 2 turns. We went from the mid-7s to the mid-5s last year, which we think 2 turns of leverage is great. We're going to decrease it another turn this year to get to around 5, or close to a turn to get to around 5, another half a turn next year. I think by the time we get into early 27 and we're going to be in the 4 range, I think that's a very competitive position and should unlock value on the equity side of our valuation.
And Harry, before we let you go, we spoke to you at the end of February, and one of the points that you made was if we saw relations restored with Russia, if Russia opened back up, that would be a major tailwind for your company, given that St. Petersburg, that cruise line, was very, very profitable for you. Now we're at the pretty much the start of May, the end of April. Do you think that we're any closer to that point?
It's really hard to tell. I'm not an expert in geopolitics. Listen, we hear some positive noise. We hear some constructive comments out of Russia that they're willing to start talks, but really difficult to read the future on that. But I just want to be clear, although that could be a tailwind, we're very happy with our deployment. Where we are in the Caribbean, Alaska, deployment for Europe for next year is doing very well as well. So we're happy with what we have today. That could just be an incremental tailwind to us if things move forward.
All right, Harry, thanks so much. Harry Sommer there talking to us from Norwegian Cruise Lines. It looked like they were going the other way of the other cruisers.
Exactly, yeah.
Because they were so optimistic about their forecasts.
Yeah.
RCL and CCL.
Yeah, exactly. Norwegian Cruise Line is striking a little bit of a more dour tone when it comes to their outlook. Let's talk about how dour the stock market looks right now. The S&P 500 down 1.5%. We're off session lows on both the S&P 500 and the NASDAQ 100, but I will point out it is the end of the month. We could see some funky window dressing when it comes to the next several hours. A lot can change between now and 4 p.m., Sonali.
Certainly a lot can change. We're going to take a look under the hood now this hour with Bloomberg's Isabelle on individual stocks. What are you watching?
We're looking at Caterpillar. So the stock is edging slightly higher by 0.3%. So here's another company that's presenting dual outlook or twin outlook. So first, Caterpillar expects slightly lower sales this year if tariff remains in place and if we do dip into a recession in the second half of the year. So that guidance came in line with estimates. The second is without tariffs. So without tariffs, the company is expecting profit to be at the top end of that range with sales little change from last year. And as we know, Caterpillar is really seen as the bellwether for economic health because it's such a big company and it's more into equipment heavy making equipment. And the uncertainty really has left a lot of executives really just a little anxious.
Do you know the etymology of the word bellwether?
I was hoping you would tell us.
So a wether or a veeder is the castrated sheep that leads the pack.
God.
And that sheep would wear a bell. So the belvedere is where that comes from.
I actually knew that because you've told us that before.
I know, but I feel like not everyone knows, so I want to share the intel.
I don't know.
Let's talk about Starbucks. They had a drop in same-store sales globally, really led by the USA, right?
Yes, exactly. So shares are edging lower by 8%. And the key word for this company, I think, is progress, because the CEO, Brian Nichols, said that there's no denying it, results were disappointing, but under the hood, we are making progress, and that's really what he's banking on. And we know that since he took the helm in September, he's tried to make some changes. He tried to make the lines less long. He streamlined the menu. He didn't want people ordering in-store to wait for a long time just because people who are ordering from mobile ordered from mobile. And one thing to note, though, that ever since he took the power in 2024, September, the stock has edged lower by 15%.
Yeah.
But still, maybe it's too early to judge.
It's a tough time to try to execute a turnaround. I could have told you that same-store sales are going to drop because I started drinking company brew.
True.
My grande cold brew costs more than $5 a day, so I stopped doing that. So there's your indicator. Let's also talk about Snap, though. An interesting read on ad spending as we count down the hours until we hear from Meta.
Yeah, this is curious. The stock is edging down by as much as 16%. That's the most since August, and they narrowly beat estimates, but they declined to issue a sales forecast for the current period. So that really caused some angst in Wall Street. Like many others, they cite macroeconomic uncertainties. We have Morgan Stanley actually saying that their decision to pull their guidance this early speaks to maybe how the business is in worse shape than previously thought. So I thought that was some strong words there. Guggenheim room with James City, everyone was cutting their price target. But they're not the only ones. We know that even Porsche warned of shrinking profits. JetBlue also pulled their full year outlook, and GM also reduced their guidance. So maybe this is a trend.
I want to see the overlap between people who drive Porsches and people who use Snapchat, because I don't think there is any.
Hopefully not.
Yeah.
Yeah. The answer is no. Anyways, Bloomberg's Isabelle, we thank you so very much for all of that. Now, coming up next, Trump is marking 100 days with a rally and some relief from auto tariffs. We're going to look ahead to his next 100 days with Wendy Schiller of Brown University next. This is Bloomberg Open Interest.
We will end inflation, slash prices. We've already ended inflation, raise wages, and give you the greatest economy in the history of the world. That's already happening. You're not supposed to criticize the Fed. You're supposed to let him do his own thing. But I know much more than he does about interest rates, believe me. I'm proud to be the president for the workers and not the outsourcers, the president who stands up for Main Street, not Wall Street. You know, I like Wall Street.
President Trump there marking his 100th day in office at a rally in Michigan last night. Joining us now to look ahead to his next 100 days is Wendy Schiller, director of the Taubman Center for American Politics and Policy at Brown University. And Wendy, we've got some breaking news from the Trump administration. Every 5 minutes this happens. But now his Department of Justice is asking a U.S. trade court to reject a lawsuit by small businesses that challenge the president's global tariffs. Trump is arguing, or his DOJ is arguing, that judges don't have the authority to review the national emergency that he invoked to justify these sweeping levies. How do you look at this sort of IEPA challenge?
Well, the Trump administration sees an advantage of pushing things back to Congress because the Congress at the moment is controlled by Republicans. The House seems far more willing to go along with Trump in every way at the moment than the Senate does. But by making the argument that this is essentially a constitutional congressional power, the power to impose import taxes, which are tariffs, and that the only way the president can do this is under the suspension of congressional authority, and that becomes an executive authority for national security. The courts have nothing to do with it. If Congress wants to reassert its power, it can revoke the suspension of this authority and reassert itself and take over the power again, which it chose not to do when it extended the funding for the government in the most recent CR. So that's the argument the Trump administration wants to make. And I think this is an argument they have been making in other realms: immigration, deportation, cutting jobs, cutting spending in the executive branch. This is a sort of a sweep for power, willing to share with Congress, knowing that the GOP-controlled Congress won't challenge the president.
Well, let's talk about this vote. I mean, the Senate's set to vote as soon as Wednesday evening on that resolution terminating the national emergency powers that Trump has used to control these tariffs. Does it have any chance of passing, Wendy?
Katie, I don't think it has any chance of passing right now, this month, this day. But as the pressure on the economy builds in terms of the perception of the consumer and the voter. So when you think about this, it can be self-fulfilling prophecy. If we think the economy is in trouble and we think there will be higher inflation and people will lose their jobs, then we will pull back, which then, of course, creates a cycle. And the Republicans in the House don't seem to want to internalize the fact that Trump is in large part creating this cycle and contributing, I think, to some of the consumer pullback. So, it's still a long way to 2026, but they are starting, there's some signs, they're starting to realize that voters are anxious and that if they don't start to assert themselves vis-a-vis the president, then they will pay the price, I think, in 2026.
We came in with some sound from the president as well, this idea that he's for Main Street. But I want to point out that this challenge to these emergency powers are from small businesses being impacted by these tariff negotiations. We just spoke to Rebecca Minkoff yesterday as well, really saying that a lot of her peers might not exist if this keeps continuing on. What is that challenge to Main Street that's being created right now in the midst of these tariff wars?
Well, Sonali, what we're seeing is that two things. One is it is costing more money to buy or purchase goods that are coming from abroad, even with 10% tariffs or 25% tariffs. And then it's anticipation. If it's going to cost my business more later, then I pull back now to survive. So a lot of this, again, it's not all psychological, it's practical, but it's also anticipating that Trump won't move off these tariffs and Congress won't assert itself. We're seeing in town halls across the country, Republican districts, Republican voters who say, I'm a Trumper, I like Trump, but this could hurt me. This could put me out of business. Why aren't you doing anything? And that is trickling up. It's a little bit quieter than we see in D.C., but out in the sort of hinterland, we saw just in these most recent town halls the last couple of weeks, voters are making their concerns known. And the question is, will Trump listen? Will Howard Lutnick listen? Will Scott Bessent listen? Will Trump change course? Last night's speech indicated to me that he is not budging.
Wendy, there was a lot of talk during the great financial crisis about turning the Keynesian economy or impulses on its head and going the way of Hayek, right? And saying we need to take our lumps. This is going to be painful, but we will turn around the way the U.S. economy works. And I wonder if in history there is any example of a president or an administration that has put the economy through pain in order to come out better on the other side. When you look back, do you see anyone who's done that successfully?
I'm not sure I know examples of presidents who have purposely put the economy through pain. But Ronald Reagan faced a difficult economic environment in 1981-82. Passed tax cuts anyway, increased defense spending. But, things were not great for the Republicans in the 82 midterm elections. By 84, when he runs again, things are starting to look up. We see George Herbert Walker Bush lost his presidency, but Clinton still had a tough time in the first 2 years on the economy. And George W. Bush inherited a budget surplus, and that sort of evaporated, of course, after tax cuts in 9/11 and the two wars. So presidents have taken steps that have caused short-term pain with an eye to sort of getting us back on our feet. But the external shocks that nobody can predict sort of threw them off course. In this case, we have to ask ourselves if the Trump economy is actually suffering, and it is now a Trump economy, not a Biden economy, because of external shocks or external reaction or internal presidential policies.
We've been talking a lot about the tensions that have been brewing between the White House and the Federal Reserve. Of course, we had overnight again President Trump renewing his campaign against Fed Chair Powell. He didn't say this time that he would try to remove him, but he did say he's not really doing a good job. At the same time, investors are listening. You have, for example, Jim Bianco of Bianco Research asking online, has the shadow Fed begun? Or if Trump will nominate Kevin Warsh to replace Powell, term ends May 2026, it's all on our calendar. How long before we start weighing Warsh's words more than Powell's? What's happening at the moment between this dispute? What is it creating in terms of where the attention is being drawn for economic policy?
Well, I mean, this is you could argue an inside game that's happening at the same time that voters are trying to sort this out. And most voters do not understand the role of the Fed. And we've seen since the economic Great Recession crisis of 2007, 2008, 2009, sort of the manipulation of interest rates. And that's what a lot of people think. That's what Trump used to say, at least in his first term, that the manipulation of interest rates is solely in the control of the Federal Reserve. And he expressed frustration with Powell. He got rid of Janet Yellen, put Powell in, but then got frustrated when Powell didn't react to what the president was saying. So building the rhetoric and the narrative against Wall Street, against the sort of elite manipulation of how much it costs to get a car loan or get a mortgage or, you know, any credit card debt, any of those things most voters don't really understand the mechanics of. So Trump has an opportunity to say, listen, let me control it all and I will make it better. It's not my fault. It's this shadow elite organization's fault. Let me get my guy in and things will be better.
All right, Wendy, got to leave it on that note. Always great to speak to you. Hope to do it again soon. That is Wendy Schiller of Brown University. Now, coming up today and tomorrow are the two busiest earnings days of this reporting season. We're going to take a look at the companies you need to be watching next. This is Open Interest. Welcome back to Open Interest. Let's get a check on these markets. The S&P 500 on track for a third straight month of declines. The big index down about 1.4% at the moment. Big tech leading the losses right now. And you can see the bond market relatively unchanged after some big moves after the economic data that we got this morning. Now, we know that today is a big earnings day. We have Meta and Microsoft after the bell tonight, guys. Meta, the question is, what does ad spending look like? Microsoft, AI spend, are they pulling back on those data center leases? A lot of existential questions there.
It's down 3.4% in the trade today ahead of those earnings. So you have to wonder if they have so much to say here that they can kind of turn some of the sentiment around. Guys, almost every sector is in the red today.
Yes, it is a down day in the market. It is also the last day of the month, so it's hard to read too much into these moves. And I will point out, Matt, the volume is pretty light. Yeah, is volume still light? I guess that makes some sense. Yeah, off 18% from the 30-day. Only 2% from the 30-day moving average.
I do say, though, that the 10-year yield is showing you that the market is still more concerned about growth.
Tomorrow we have Nancy Tangler from Laffer Tangler, as well as Vlad Tenev, the CEO of Robinhood. This is Open Interest.